All right, everybody, welcome back to the Bear Trap Discord podcast. My name is John Kirby. My co-host is Vic. All short credits, as always, go out to Auk. This episode is actually our doomsday prediction, so to speak. We're finally, the cusp is nigh, as they say. As always, we don't know what's going to happen, but we can identify weaknesses in the distribution, periods that provide an opportunity for more weakness, and that's what this is. So yeah, I guess this is probably a bit of an important one. We had to cut it a little bit short, but I think there's enough in there that you'll get the idea. Yeah, so like, share, subscribe, etc. Hope you enjoy. We're actually, it's kind of funny because a lot of people are super stoked about this breakout, and thinking that, right, because we had obviously this massive trend line. Let me see if I can draw it on here. We had this massive trend line from the high, this is on the E-minis, it doesn't really matter what you use, ES, SPY, whatever. Massive trend line, three highs, 3 points connected. Then this was a big CPI that broke through, and then we came right back inside the zone. We finally started to break out. And so the thinking goes, okay, we're breaking out because we're getting a quote-unquote soft landing. And I guess what that means is that we're raising rates, but we're raising it at precisely the right rate that will simultaneously curb inflation and not suppress the economy, so that everything is going to be fine, essentially. And I don't know. I don't really find it super convincing from just a technical standpoint, even because if I look at this, for instance, like if I'll go to this daily time frame and then I have my little linear regressions or whatever, we're still well within sort of the same channel that we've been in for a while. So it's almost like from a technical standpoint, we're in a different channel, but from a statistical standpoint, we're really in the same sort of zone. And that's kind of like what I use to, I think technicals are useful to trade off of if you're especially like on shorter time frames and stuff like that. But
yeah, sure.
Statistics are a little more useful to draw conclusions off of.
Yeah, no, I totally agree. So what are some of the, I was saying this in the Discord the other day that this was a massive bull trap. Why would this potentially be a trap for folks? I'm just, hypothetically, because you say you have some reticence to it. Technically there's a reason for that, but what are some other reasons maybe that bulls may be falling for a trap here?
One of the things that you would, let me start with the good signs. One of the good signs is that we are seeing market breadth, right? In other words, everything is moving. We have defensive sectors that are actually coming off, while constructive sectors are rebuilding, right? So defensive would be whatever, cyclicals, utilities, staples, all those sorts of things, and then constructive sectors. I think about all the more speculative stuff like tech and all these things. But something that you don't really want to see when you're looking at something when you're looking at a recovery is, I'll use a couple examples. I think Meta is a pretty good example, right? That 25% off of the bad earnings, and then saying that they're going to do the share buybacks.
Yep.
Or you can look at Tesla, and the ramp up, right, from whatever that was, like $100 all the way back up to almost 200. They closed just shy of 200 handle on Friday. Or Apple's a great example too, because Apple had their worst earnings since 2016, and yet the thing gapped up and rallied.
Pretty silly.
So there's a difference between breadth and exuberance, is kind of what I want to say.
Does this have any of the makings of the beginnings of a blow off, like maybe blow off swing high type top here?
It's starting to seem like it. I think one of the issues that we're having a little bit is that, again, if I want to be true to this sort of statistical nature of these types of longer term analyses, we actually have room all the way up to 4450 on ES technically, before we're actually it seems like we're actually getting out. And it's not likely that we're going to get all the way up there. I'm just saying that like we have a lot of space here. There's nothing in the way.
So, I mean, let's talk cycle then. Okay, so technically there's space. I agree with that. There definitely is. We're in, again, we're in like meme mania again with Carvana going from 3 to 19, 3 to 20 really. You had Tesla that dropped from 330 down to 100 within months, and then back to 200 within a month, I think. Meta, if you look at the Meta chart, it's so fascinating. I wish I would have got this to you, but you know the return to normal, and then you basically know the market cycle chart that people like to throw out there, and it's like you got return to normal, then you got capitulation, then you got the despair levels, and then return to the mean. That chart of Meta looks exactly like it, and we came right back to the mean on
yeah, like
Meta.
on this weekly. Yeah,
yeah.
We did actually come right back to the mean.
Isn't that crazy?
That is crazy.
That chart is perfect. So what I think of it as is like, okay, first off, gosh darn it, I didn't buy the despair levels like I said I would. I'm waiting for Bitcoin to do this kind of thing. I didn't do it in Tesla either, but we haven't seen a lot of other big stocks do this yet. Like a Microsoft, I would think would probably be the next one.
No, that's true. Microsoft and Apple are not there. And for those of you who will say, well, that's just one stock, how much does that mean? The problem is that, because the market caps of these guys are so inflated and they constitute such a large percentage of the index, in order to actually see exhaustion in the SPX, we need to see exhaustion in Microsoft. There's no way around it.
Yeah, and so exactly. And so do I want to see these stocks sort of make the same kind of move that Tesla and Meta, like Microsoft, Google, Amazon? I don't know if Amazon's chart looks like it. I actually haven't looked at it yet, but Apple mainly.
People hate Amazon, man.
Yeah, Amazon sort of looks like it, sort of like a despair level buy.
Well, one of the reasons that Amazon's a little messed up is because you see this move up here, right? That was COVID.
So they had a little bit of the COVID exuberance in there.
Yeah, exactly.
So it may have already made its move.
It kind of skewed the entire chart. That's the issue there.
And I'm not necessarily looking for all the big fangs to make the exact same chart pattern, but it's a similar type of thing where it's like they went to these despair levels where you thought the stock was completely done for, and then they rallied huge. So I would like to see like Apple do that first. Google sort of attempt to do that. Google may be a little different, I'm not sure, but get these stocks sort of down there into those despair levels, which would take SPY with it as well. But for me personally, for this to be called a new bull market, I don't think it makes a whole lot of sense, because what caused the bear market that we've had is not necessarily gone. You know what I'm saying? So
well, yeah, and this is I mean, it's sort of it's the classic case of the market trying to front run everybody, right? Because the idea is, if we are in a case in which we have a soft landing, we're not going to know until we don't have a recession.
Here's the thing, soft landing though. I mean, something that Jim has talked about on the Top Traders podcast was that the soft landing is actually the worst case scenario for the markets, for stocks. Whether the economy is good or not is not important. It's only important for what you expect stocks to do. But if you think the economy is going to be great, does not mean that the stocks are going to perform well. And he always refers back to this period of time, which I wasn't alive in, but he talks about, there's a period of time where there's like a whole decade where stocks in real terms didn't return anything, even though the economy was ticking higher.
Yeah.
And so he's talking about this sort of scenario where it's like it's soft landing. And if that's actually true, it's not going to be great for stocks. Doesn't mean this you can't make money in stocks. It's just not going to be. We're just not going to see new all-time highs.
Well, and I mean that's it. It's really a rate things, right? It's a question of because the stocks equities are forward-looking, right? So if our expectation is that our rate of growth is not going to outpace our rate of inflation for a little while, meaning a year or 2 years, then it's really, really hard for equities to actually move. So
It,
if you are bullish here, then essentially you're thinking that GDP is going to be able to outpace the rate of inflation. And even if we're saying we're going to have lower than typical inflation, right? Like let's say that we keep a 4% rate, there's literally no reason for, right? You're only getting a 2%. Like let's say that you're having your GDP is growing at, it's hard. I mean, GDP usually grows at like 2, 3%, right? It's like it's not, it just doesn't make sense.
doesn't make sense. So you've got a lot of the conditions that cause this bear market still present. And even if it is a soft landing, well, that doesn't mean we crash, right, for stocks. But I think you see a lot more of what happened in 2022.
Well, I mean, what's going to create the crash is the fact that we're not going down, right? Like if we get these moves that create overexuberance, and they also create too large of a differential from a true valuation.
So let's talk about that, because what's coming up here in a few weeks that supposedly could set up something like a nice move lower. I'm not going to say it's a full-on crash, but you have this window here where a lot of the flows that have been holding the market up, at least in my opinion, and some others, are going to basically be gone. So
yeah, so I mean,
XX.
this is kind of a question that I have, right? Which is that I'm trying to remember back because it's been a while. We haven't had a positive gamma dominated OPEX in a little while. And so I'm kind of wondering whether we squeeze into it or rather the expiration, right? Like whether those charm and fauna flows actually keep us down. They keep us muted. I
And
think
so
it's the
that gets
latter.
into your how is everything positioned into these expirations? Are we going to see a squeeze, like a situation where the market's up, VIX up type of thing, where it doesn't make sense, and it's just this kind of blow off top situation where you see a SPY like 440 or something like that start printing?
Yeah, I mean, I could actually see that as well, right? It's like this. There's no real reason for us to, unless CPI comes out on the 14th really bad. It's really, really hard to get us out of the positive gamma environment. Um, I mean, we saw that earlier in the year. I remember trying to short during that July rally, and
Oh,
it
it
really
sucked.
it sucked.
Well, you got the super low skew in the back months, and so every time skew rises in the next couple days in the front expiries, it just gets killed, right? Because there's just no reason for the market to actually cause a vol event. And
What is the mechanics for that? Because this is, I mean, that's something that I don't quite understand yet. Because to my mind,
sure,
it's almost like how would I put it? Or
we'll pull up skew real quick. Let's just see what I haven't looked at SPY yet.
yeah,
For tomorrow, just because I usually wait till the morning. But so I mean, we kind of always refer to this chart just sort of to get an idea of the expectations into these future expiries as far as IV goes, and everything's pretty. It's raised up a little on the left tail here if you're an aficionado here of these and you look at these all the time, but vol is still sort of low, and so every time you see these front dates, like tomorrow is obviously the 6th, so 6th is kind of low. I expect it probably to go up and probably drop off again. Just because you got every other expiry sitting there at like less than 20%, and you got VIX sitting at 18.
yeah.
So we can expect the vol of the day or the next couple days, especially if there's no data releases that surprise the market. Even the surprise on Friday was sort of muted, in my opinion. Having a release of 500,000
Yeah, no,
versus
that was insane to see nothing with.
versus expectations of.
Yeah.
So what I've been saying on Twitter a lot of times is, I'm looking at this skew and I'm just going, I don't see how we can even crack, how we could go down, because of the way the rest of the skew looks for all these other expiries. Not until not until the skew can go up a little bit. I'm not worried about the next couple days. In most cases, it's just going to be a vol crush. That doesn't mean we don't go back down, kind of like on Friday, where you bought
Well,
your
what
4150
happened
puts.
on Friday was really funny because it was we didn't go down because because implied vols actually came up a lot. I mean, they did a little bit,
No, they
but
didn't though. I was watching the VIX. The VIX was going down.
that's true. What happened was uh, it was kind of funny because implied vols only started coming up once we started going down. But the only thing that did happen before we started going down was that implied vols on the call side started to come up. And so it created a sort of imbalance. And then that's what started to bring us
So
down. So it's almost like,
I wish we could show Friday's charts, and you don't have to go look them up if you can find them. That's fine.
well,
But
this actually is Friday. This is a Friday
okay,
chart that I
cool.
pulled. And you can see how it's different from all these other guys because the call side is actually elevated a little
Yeah,
bit
yeah.
here.
Okay, so that's a great example and then you had all this you had a lot of GEX sitting at like 420, 417 positive GEX gamma exposure that was sitting there for a few days on Friday. So a lot of that expired. And I think it happened as folks are kind of there was sort of this second attempt up into those levels, and it just got exhausted. I mean, but what I mean was it's like, okay, we had this crazy outside, almost like tail event in the data release. Because I don't know, I've seen all the data releases for NFP. I don't remember one like that where it was so off.
No, I agree. When we saw that in the morning, I was looking at it and I was thinking,
I
oh
mean, I
man.
bought puts just because I was like, okay, this has got to at least race skew a little bit
Mhm.
into next week, especially with what I know is coming potentially on in VIXX and CPI. But no. In fact, it was another vol crush. Even with, you had such a crazy, unexpected surprise to the upside that was bearish. It's bearish for the market, um, but it's just not bearish for today. It's actually more bearish for long term. So that was my bad read on that, because I know it's bearish, but it was, there's just so much vol supply right now that it didn't matter, man. People were still, closing their hedges and closing their shorts and getting squeezed. And so they get squeezed into the positive GEX up into 417, 420, and and then you get the you get that GEX start to expire into the end of the day, which essentially causes the sell off, in my opinion. But which you probably could have seen it. Probably could have seen that earlier on. Uh, if
Well, the big difference was between skew at the beginning of the day, or rather after we sort of reversed the NFP thing.
yeah,
Skew at the beginning of the day looked like this, where the call side was under, I almost want to say underbid, right? It wasn't
yeah,
getting bid enough, and
yeah.
then
Well,
you go into then you get into this, right? And then this is
yeah,
when we're falling.
yeah. And so that's exactly right. That's such a good picture. And so when I see that, I go, okay, vol's probably going to come down or barely go up, but people aren't going to be rushing for puts.
Yeah, especially, well, it's the issue here is kind of
So they
like,
should. Dang it, they should, but they're not. So they get crushed, and you get crushed for basically half a day, anyways. And then the positive GEX starts to expire at the end of the day. You saw it on the skew. You saw the calls going up, and that's essentially I think that's the chase.
well, I
People are
mean, the
right.
way that I think about this is like if you bought puts, you paid so much more for them than you paid for
Yeah.
calls that
See, I bought puts for Monday. I didn't buy them for Friday, but yeah.
well, in any case, what's happening here is if the market doesn't go your way, then you're getting squeezed out of more money. So you're
Yeah,
more likely to
for sure.
try and get out. Whereas on the call side, you can spend a couple extra dollars there, get more for your money in terms of exposure, and
Yeah.
you're not super worried if it goes against you a little bit because it's still worthwhile to hold it.
Yeah. Yeah, no, you're totally right. You're paying up for it. So, uh, my mistake on Friday was essentially that I knew it was put supplied into the
Hmm.
day, and it's you could have known that without looking at anything, just because it was a big data release,
Yeah.
and you could have just looked at the skew. But we're also positive GEX for the most part on balance. up to 417, 420. And so, it was an easy play just to come in and buy calls.
It was, and for the first half of the day, that was the play. And then what's tricky, right, is realizing that the what would you call it, the put um, oversupply. I mean, that would
Well,
kind of imply
people
that
got
the
out of
skew
their
would be.
hedges.
Yeah, I
Okay.
mean, basically, as we held around 417 by like midday, most of those things were gone, um, ish.
Exactly. And so then you started seeing either in the skew, you're seeing people buying calls. And whenever you see the call side sort of get bid up, it sort of sends a little bit of a red flag no matter what for me. Um, but it may not have been that. It may have just been that the skew on the left tail was falling so much that it made it
Hmm.
look like it. It doesn't
Let's
really matter.
we can actually check that actually, because I mean these are the two charts. So let's see
Yeah.
here. We had calls at a 30, and then let's see if in the new one they were towards the end. No, vols actually came up. So calls were it wasn't. I mean, like you said, it wasn't a lot. It's like whatever, five
Yeah.
points, 6 points, but
Yeah. So
um,
calls did come up, even relative to the fact that puts actually stayed high.
exactly. Puts stayed. Sorry, I missed that one. Puts, yeah, puts even came up a little bit there because they got up to
Yeah.
40.
Yeah.
But
And
I
so
mean,
that
we
could
were
have
selling
also been a
off.
tell, is the fact that vol had risen into the rally
Yeah.
and the fact that you had calls bid up. Yeah, that could have definitely been that was a great call to hit that reversal on that for sure. Even though, yeah, if you know that all the hedges are pretty much gone by that time that were there for NFP, because a lot of those people that have puts for NFP are sitting there for who knows how long, you know, they're not buying them again uh, in the end of the day. But yeah, it's just interesting how that plays out in the skew.
But
Um,
I guess it kind of makes sense. Maybe we should articulate it this way. When we have longer dated skew so low, if we do get zero DTE skew that is elevated or like elevated short-term vols, there's more pressure on those people to liquidate, regardless of whether they're in puts or in calls, because if they roll their maybe you'll be able to help me with this, but like there's no smooth roll to later expiries. Um,
oh, I see what you're saying. Yeah.
I mean, you can see it here by the massive gap that there is between everything down here and everything up there. That
Let's put it in context real quick because you're saying there's no smooth, nobody's rolling to other expires, and this is what Jim has been talking about on his interviews and podcasts and stuff. Is saying that funds aren't buying vol anymore in the future.
Yeah, exactly.
They're buying their vol based on realized volatility, and what that means is they're not playing implied volatility, and they're not playing it out on the term structure. They're playing it zero DTE.
Yes. Perfect. Okay, so that actually does connect uh, perfectly what I was trying to say, which is that if you're going to play out, using your terminology, you're going to play out moves on zero DTE only because there isn't enough juice on later DTEs to get yourself some continuation or whatever. Um, it's sort of like I mean, like everything in the market, it's a reflexive process where everybody knows that everybody else is doing this, which means that there's more pressure to liquidate on that day. And if there's more pressure to liquidate on that day, whichever side has the higher implied vol is under more pressure. So if your puts have a really high implied vol, you're probably going to squeeze. If your calls have a really high implied vol, you're probably going to come back down because the holders of those things will recognize that the vol is higher than the deltas that they'll be able to realize with them in that time frame because they can't roll out or anything. And what happens when you can't roll out? It's not so much a question of um, you as a customer. It's more a question of what happens to dealers, right? If as a customer what you want to do is you want to cash out on your position immediately, and you're not entering into a new position because the day is finite, then the hedging obligations of dealers are also in some sense finite, which means that you don't get these really continued moves. Rather, you get this sort of whipsaw type of action.
Right, exactly. And it's so funny to hear that I never thought about them trying to capture the realized vol of the day because I implied vol is so underperforming. And I think that speaks to the fact that implied vol is essentially just the market's prediction on future potential movements, right?
Yeah.
It's so bad right now. What do they call this? Like a dispersion trade. Like nobody agrees on anything. Everybody thinks it's going to be a new bull market, but everybody also thinks it's going to crash. I hear this on Twitter all the time. Everybody's bearish. No, they're not. Everybody's bullish. We think
Oh,
we're
I
going
was
all
I
time.
was I was
They're
taking I
not.
took some of the time over the course of the week to look at put call ratios as well as some of those gamma edge gex ratios.
Uh,
Um, and the conclusion was really simple. And it's people are not loaded to the gills in puts. They're not.
they're not.
Um,
No, it would be in the skew. If you saw people in puts, the skew would be look a lot different right now, in my opinion.
yes, it would. And also, if you look at the gex ratios, um, we're actually in a middle zone. We're in a no man's land. It's kind of like half puts, half calls. It's
And so this
not.
is what I mean by the implied vol that we're seeing is not it's an extremely bad prediction right now. And I think
And
this is what Jim keeps talking about is going, well, all the funds that were essentially just crowd trading this short vol situation, and then all these other funds that were trying to make these bearish bets by buying vol or hedge by buying vol, they don't do it anymore because they can just play the realized vol during the day. Why mess
yeah,
around with the implied vol when it's just so bad at its predictive powers, essentially?
I really, really like that concept. And I want to kind of highlight it from another angle. The way I'd summarize it is in a split or polarized market, implied vol is underperforming. The reason for that is because um, I think maybe split isn't enough. Maybe we do need to say polarized, right? If there's a lot of people who are bearish and a lot of people who are bullish, and there is approximately equal quantities of each, then the bullish people will be willing to pay out the notes for calls, and the bearish people will be willing to pay out the notes for puts. And because they're fighting with each other, neither the calls nor the puts will ultimately realize. So it can create a dynamic where we're getting high implied volatility consistently because people are willing to pay for options. And yet, there's no realized volatility. In other words, those options do not move the market enough to actually create any sort of cascade in either direction.
Yeah, and this is where I think we get this situation where the market doesn't crash necessarily. Like we may have some vol events here and there, but it's going to be a slow grind lower because you're going to get the vol underperforming on both sides.
Well, unless there's some sort of decisive metric.
Sure. Obviously, yeah. I mean, you got to be open to anything. Something shows up and it changes everything. The Fed starts quantitative easing 6 or something. It's like, well,
But
okay.
I don't just mean the casual like, oh, they could drop a nuke. I also mean that isn't this the sort of dynamic that could potentially lead to um, a massive move eventually when
Yeah.
one side everybody hops on one side at the same time?
No, and this is something that Jim talks about a lot. I know I always bring him up, but I'm like, what he says just makes perfect sense in that, like, in this picture right here I'm looking at, I'm extremely bearish here. And the only reason I'm extremely bearish is because I know the factors that cause the bear market are still there, but the positioning is way different this time. Where in 2022, we grinded lower for the most part of the year. But we didn't crash was because the positioning was still so bearish that
Yeah.
it couldn't really crash. So vol underperforms. Right now, it's a totally different story.
It's kind of amazing. I don't know how he saw this because like now as we're articulating it, right, and sort of implicitly in terms of the price action and whatever, maybe I kind of register this on a day-to-day basis, but I didn't have the conceptual framework for understanding why this type of skew is fine until it isn't, until we were having this conversation and sort of puzzling it out. But if you think about it, Jem was thinking of that this was going to happen, a month ago, 2 months ago.
No, he's actually been thinking this for more than a year or maybe even longer than this.
Well, that's insane.
It's crazy, I know, but he's basically looking out at the whole structure and he's going, well, look, basically this is how dealers and customers are positioned out into the first quarter of 2023. And so we can't, there's no, unless it's some crazy Six Sigma move, you can't have the type of fall event that you want if you're a supermarket bear. You can't have it right now. The environment's not ready for that. It's not going to be until everybody's sort of swept out that was a super bear or superposition bear anyways, and start looking towards the upside. Because
What
everybody
if
that was positioned bear right now, and you see the trend line break that we talked about at the beginning, and
mhm.
you see the golden cross 50 day just moved over the 200 SMA on the daily. And now you're thinking, okay, well, maybe I was wrong. And now I need to start looking to buy some upside here.
I was for a second I thought to myself, oh, maybe I was wrong.
You
And then
thought that too, huh?
and then I saw Facebook move 25%, and I was like, no.
No, right, exactly. It's well, and that's the other thing too, is like you've had all these bad like Netflix. They went down on earnings but then came back up and now they're like trading higher, I think. You had Tesla gap up on earnings and continue. You had Apple, worst earnings ever, I think, or whatever it was, gap down and then trade higher. You had Meta. I mean, that was an insane move for Meta. And that's even off the lows. So that came up. So if you look at all that, you put that in perspective, I'm a mega bull right now from those factors right there. But then that's when this stuff starts happening though. And this is, if we could go back to COVID, like right before that happened, I bet you
Yeah.
a lot like this skew.
Yeah. No, it makes sense. I was gonna say, why don't we take a look at the open interest and see if the options positioning kind of reflects what we're thinking, right?
Yeah, for sure.
Because we're seeing something in the skew, we have an interpretation. Yeah, let's see.
But then here, I'm looking at I watch the flow all day long. I watch sweeps and floor trades all day long. And single legs really, but you start to get an idea that somebody feels the same way I do about what's coming. A vol event of some significance is potentially in the works. But let's look at this.
Yeah, that trade that came in, what was it, like 104,000 contracts of 25 VIX calls for March 17th or something?
Oh, really? Okay.
Yeah.
17th. Huh.
Yeah, I
That's
forget
interesting.
17th or 31st, but there's some crazy action coming
So
through
they
the
just rolled
VIX.
back out. They just rolled out to the next VIX-X then.
Yeah, I guess it can't be the 17th, right? Because that's not a VIX-X. It has to be
15th.
either,
It
yeah,
doesn't,
15th.
it doesn't have to be. Yeah, it would. Yeah, it'd have to be the 15th. But yeah. That's neither here nor there. The open interest here. So obviously the AMs again. Here we go. With OPEX being 18% of the OI here, February 17th AMs.
Yeah, and then March 17th AMs, and then April 21st. Okay.
And March
So
17th, 38%. Man, maybe that's why this guy's buying these VIX calls.
yeah, it's kind of funny. You do see, at least when I look at this SPX open interest, I do actually see a lot of what we were talking about, where like we're still it looks quite symmetrical.
Yeah, it definitely does. And so what we're talking about, where people are they're either in the full camp of hey, I'm a bull now, or they're in the camp of I'm still super bearish. That's what you start seeing. Like I don't know why you start seeing. What's funny is I was talking to my mom today. They always say like when your mom starts asking about investing in stocks, start to get weary. So she's asking me about, hey, I was talking to this guy and he was telling me the S&P 500 was a good place to invest. She's been trying to invest for a long time, but she's never actually said S&P 500 to me.
Yeah.
And so I was like, Mom, don't do it. Okay. Not right now. And it's just so funny that she would do that right now. Right when I'm pretty sure we're close to a local top. It's just funny that my own mother was coming up to me asking me about stocks.
Well, I remember back when everybody was talking about oil stocks again, like Oxy and stuff like that.
Yeah. And I
Like,
had another buddy, longtime trader, 20 some years he's been trading. He's an older guy. He just got blown up. Literally. He had to borrow money from his son.
oh God.
Yeah, and so he's an old retired guy that's been trading for many, many years, got destroyed on shorting no, on buying natural gas
Oh, that's interesting.
and lost pretty much everything. Sounded like that's what he told me today. And so I'm like, okay, so these people that I know, my mom's asking me about buying S&P 500, and this guy got blown up.
I mean, that means it's time to buy nat gas, man.
For sure. That's what I was thinking too. That's exactly what I said. I'm like, okay, well, how much is it trading right now? Because I'm gonna go buy some.
I've been
It's
thinking
crazy.
I've been
It's
thinking
like,
about buying some for a while, but I mean, from a seasonality perspective, it's a little rough. Like that's why this guy's dying. But sorry, that's neither here nor there.
no, it's just funny because you're in the market all the time, and you're like, okay, I'm pretty sure we're close to it. It seems kind of FOMO-y, it's kind of frothy up here. People aren't positioned; they're not hedged at all for any kind of tail event. I don't even think it would take a huge tail event to take us much lower.
That's true. One thing that I'm not seeing on this SPX chart, that's a good way to put it. I do not see. Do you remember way back when we were looking at, we're like, oh, they're still in the 3800s. Oh, they're still in the
Yeah, for
3600s.
sure. Yeah, yeah.
Yeah. And now, I mean, what are they on the 4000s? Like, give me a break. There's nothing. There's
Well, all
nothing
I
under
see is
here.
JPM collar here. I don't really see anything else.
Exactly. It's just JPM collar. And then, I mean, SPY is a little bit different, right? Um, which is interesting. I don't know what to make of this off of the bat.
You just look at it like a profile, as a distribution. So, but it doesn't look that bad to me here. Uh,
17 is 29%.
yeah, you see that the
Um,
put call is still pretty bearish,
yeah, it
which
is.
means folks are fairly bear further out. But
Why would the positioning on SPY be bearish than, because to me, I like read this a little bit where I look at this and I'm like, I think, okay, more retail is playing SPY than SPX, right?
for
Um,
sure, yeah, and more people. I think funds are hedging more in SPX now or in SPY than SPX, but because they got zero DTE now too, so you're probably going to see more flows in there for that. But um, I couldn't actually tell you that for sure, but that's just my theory on it. Um, but
yeah, I just this one does seem like this does look a little, um, but it's very well distributed. Whereas I remember way back when we would have that one strike that was the like big hedging strike.
yeah,
And this one is
yeah.
pretty well distributed. I don't know what that means.
Well, I mean, so look at the laddering that's going on here to the downside. What I mean by
Oh, now
what
I
I
know
mean
what
by
it
that
means.
is
Yeah.
it looks like a ladder. Like it's pretty even on each strike as far as if you consider all the expiries. Um, it
Downside
get
laddering is toxic. That's what can create cascade effects, whether to the downside or the upside.
and then you look at the upside, okay, and it doesn't look like there's anybody even trying to play it. Like to me, I look at this, and there's nobody trying to play upside here.
At least really far upside, right? Like if you're looking at
Right. Okay, yeah. You want to move it up into 430, okay, that's fine. But I mean, that's like, man, that looks like max limit to me as far as what the options market is trying to price in here. And so this is what you got to look at on a total picture wise. But, on a day-to-day basis, obviously it gets a little bit more, less clear. But if you have this picture in mind, you can kind of know who's going to get screwed on a day-to-day basis. Um, but if I'm looking at this, I'm going, holy smokes, man! Everybody's just buying puts. It's not, but they're buying for. I mean, my goodness, way out there.
not only way out there, but they're going all the way down into the 340s, the
And so here's something Jim
330s.
talked about. Jim talked about this particular situation where he said, you remember the gamma squeeze that happened in 2020?
Yeah.
Well, that was caused by calls, crazy retail calls up
Hmm.
the chain, right? And that's what happened with GME and AMC. They're buying, and Carvana recently it happened where they're buying the top of the chain, and even Tesla, they're buying the very top of the chain, and they're
Hmm.
just loading the boat there, and then obviously all the way down.
Well, I also I want to reiterate though that the difference here um, in structure is that before we would see everybody hedging around the same strike, and now they're not. When everybody hedges around the same strike, as we get close to that strike, there's pressure to liquidate, which usually forces us back up. But if they're not doing that and there's this laddering, it means that once the price gets past one of these initial strikes, you only need a little event to get us there. I mean, little, we have to get out of this positive gamma structure. But once we get underneath one of them, if we do it in time, then those put holders feel really good about having liquidity and having opportunity to move their puts down to the next strike. And then that furthers our move down. And so you get this feedback loop on the way down.
And so here's what I'm gonna point this out too, because if you're sitting here and you've got all this put positioning, think about, because we've been looking at this for months now, and so think about how these puts are going to respond to a vol event.
Oh, it's going to be crazy because, okay, you can,
because they're so cheap right now.
They're so cheap, and also if you think about it, when we have highly Vega sensitive puts, right? So like we're talking about far out of the money, far out in time puts, the types of puts that are very, very sensitive to implied volatility. What happens is whenever you get a volatility event, all of those, their value comes up. So we're talking now about these March 17, March 31, April.
We're talking about these 320s going 100x.
Exactly. And then
think about the dealer who sold those.
Exactly.
What is he going to have to do now that his $1 put that he sold, or however much it ends up was sold for, just for example, goes to 10 cents, goes to 30 cents, 50 cents.
Yeah.
What is that going to be? What's the implication on the delta requirements there? Because they're going to be severely underwater if that happens, and they're going to have to start hedging that. And this is what Jem kept talking about. He even referenced that specific thing was, you're going to see these 330 puts, go from 1 cent to $1.
Yeah. Yep.
And what is that? That's where you get the gamma squeeze to the downside. And if you were looking at this and say it was, GME, but it was inverted, well, I'd be pretty bullish on GME.
Yeah, if this were the distribution that you had, yeah. Especially when we're not seeing anything on SPX that's contravening it, right? It's actually a similar-ish distribution. I mean, maybe you could argue that this strike right here,
I think it's distorted with the JPM collar. Like if you could do it without the quarterlies, maybe.
Yeah, I mean, just ignore, for everybody, just ignore the 4,000 strike and then ignore this 5,000 strike, I guess. Yeah. But other than that, right, if you're looking at, it's just the 3,900 is kind of the peak, but it's not that much greater than, say, the one right above or the one right below. So it's a pretty similar laddering. It's nothing crazy.